A note about financial stability. The Fed is interested in ensuring that the financial system is stable, and this has been a point of emphasis since the financial crisis. Under fractional reserve banking, it's important to remember banks don't have enough to pay all of their depositors off at once. This leads to a potential problem, and sometimes with banks it's difficult to identify what the problem is. I want to define two things. The first one is insolvency. If a bank's loans go bad, they won't ever collect enough to repay their depositors. So if a bank made a lot of, say, bad home mortgages and the homeowners can't afford to pay back the mortgages, the bank may become insolvent. It doesn't have enough money coming back in from its borrowers to pay its depositors. If the loans go bad, they won't ever collect enough to repay their depositors. This is called insolvency. Illiquidity is a different problem. In this case, the loans are okay, but customers want their money before the loans are repaid. I don't have to pay back all of the money on my house tomorrow. I took out a 30-year mortgage, and I have many years to pay it back. However, the bank has used money from people who might have demand deposits to make the 30-year loans to me. And if all of the people who have demand deposits showed up to ask for their money tomorrow, the bank would have a difficult time finding a way to pay them back, even if I'm still going to continue to make payments on my house and eventually pay back the loans. In this case, the bank has a liquidity problem. It needs cash today, not an insolvency problem where it's never going to get the cash at any time in the future. What can happen is something called a bank run. A bank run comes when depositors fear insolvency and run to withdraw their money. This all of a sudden can cause illiquidity, which can turn into bankruptcy. So if a perfectly solvent bank has customers that are afraid that the bank might become insolvent, then all of a sudden the bank which has a good set of loans might have a liquidity problem and might not be able to pay people back immediately. This can turn into bankruptcy and put an otherwise healthy bank out of business and cause lots of problems for the depositors. There are things that we can do to prevent bank runs. Just a couple of examples here are the Federal Deposit Insurance Corporation, the FDIC, offers insurance, and so customers can insure their deposits up to $100,000 in an account, and the bank can when the bank has deposit insurance, customers don't need to worry about a panic putting the bank into bankruptcy. Their deposits are protected by insurance, and this will reduce the incentive that consumers might have to run. Also, higher reserve requirements can help prevent runs. If we require banks to keep more money in the safe, then customers are going to be less worried about whether the banks will have enough money to pay off their deposits when they want the money back. It's interesting to think about how the Federal Reserve and the financial system has changed from where it was even just 10 years ago. There are a number of differences between the Fed in 2015 and the Fed in 2005, before and after the financial crisis. The first thing to note is, as we mentioned, the Fed pays interest on reserves. This is an important difference, and will have implications that are to this point uncertain about exactly how the Fed will influence interest rates. They control both interest on reserves, and they also control the federal funds rate, or influence the federal funds rate. Along this line, and perhaps due to the level of interest on reserves, in 2005, banks held about $40 billion in reserves throughout the financial system and about $2 billion in excess reserves. I mentioned before that banks like to stay as close to having no excess reserves as possible. The more that they can loan out, the more that they can leverage, the higher the bank's earning potential. In 2015, however, banks held $100 billion in required reserves, but $1.5 trillion in excess reserves. The payment of interest on reserves has reduced some of the incentive or disincentive for banks to hold excess reserves at the Fed. Sitting on $1.5 trillion in reserves that has an interest payment removes some of the opportunity costs associated with holding excess reserves. Also, the Fed holds trillions of dollars in long-term assets rather than short-term deposits and such. The Fed holds trillions of dollars in long-term assets. A lot of this is mortgage-backed securities. And this is very different. Also, it's worth noting that the federal funds rate has been held at or near zero for several years now. When the Fed begins to raise rates, probably later this year, it will be doing so in a very different environment than what it's done in the past. It's very unusual for interest rates to stay near zero for as long as they've been. And then we note that as we look ahead, the Fed will raise rates through both open market operations and through changes in the rates paid on bank reserves. It will be interesting to see how macroeconomic policy evolves given the changes in financial conditions in the Federal Reserve and in the banking system that we've seen since the Great Recession.